Welcome to the GCV Weekly Briefing podcast, where we break down the key financial and economic developments shaping the outlook for investors, businesses, and policymakers. My name's Matthew, and this week we'll be looking at four major stories. From the UK government's delayed budget to the surge in cybersecurity investment, the UK-Saudi investment pact, and the latest moves in global bond markets. Our opening story is the autumn budget, which has been pushed back now to the 26th of November. The official line is that the Office for Budget Responsibility needs 10 weeks to finish its forecasts, leaving the Chancellor unable to set out her plans any earlier. But delaying the statement certainly doesn't help stability. Government debt interest payments are running at about 105 billion a year, while gilt yields have been climbing rapidly. And with September and October already known for market volatility, shifting the budget has risks to adding pressure at exactly the wrong time. What started as a £40 billion gap in public finances could look more like £50 billion by November. That raises the likelihood of sharper tax rises and deeper spending cuts than would have been needed if the budget had gone ahead sooner. The impact of this uncertainty is already being felt. Businesses are hesitating as VAT thresholds hang in the balance. Savers are waiting to see if new levies on investment income will land, and property activity has certainly slowed on fears of higher taxes on main residents and buy-to-let. Analysts have suggested that bringing the budget forward could have set a clear signal of urgency and reduced speculation. Instead, delay risks doing the opposite, leaving confidence weaker at a time when it's needed most. Next, cybersecurity. Investment in the sector hit $4 billion across 163 deals in the second quarter of 2025, the strongest quarter since mid-2022. PitchBook analysis shows that the biggest winners were in data security, where deals rose by over 400% to $1.6 billion. That jump has been driven by AI innovation and targeting privacy rules. Network security also surged more than 250% as companies built out AI and hybrid cloud services. Application software nearly doubled to $936 million, reflecting concern over AI-fueled software. But not all areas shared the growth. Identify and access management collapsed by 94% to just $47.6 million, its weakest performance since 2018. Endpoint security also dropped by 55% to just over $350 million, as investors avoid complex deployments. Exit activity is told a similar story. M&As dominated whilst IPOs remained fairly subdued. Acquisitions made nearly up to 3/4 of exit values in the first half of the year. One standout deal was Sierra's $540 million Series E round, giving the firm a $6 billion valuation. This reflects how AI-native data security platforms are commanding premium prices. Valuations are climbing too. The median VC deal rose to $8.5 million in the first half of 2025, up from $5.2 million last year, the sharpest annual increase since 2014. As one analyst put it, Q2 underscored a decisive shift in cybersecurity investing towards segments with scalable platforms, rapid deployment potential, and clear AI-driven differentiation. Now, on to our next story. On September the 3rd, the UK and Saudi Arabia announced a $360 million joint investment at the Great Futures Summit in London. This deal is expected to create nearly 200 jobs across both countries and is part of ongoing efforts to deepen ties while another trade deal is being negotiated. Key commitments included $150 million from Saudi manufacturing group Al-Fanar to establish a new London headquarters for its transport decarbonisation business, a $200 million venture fund for its transport decarbonisation business. UK Business Secretary Jonathan Reynolds called the announcement proof of Britain's industrial strategy, saying it's good giving investors the long-term certainty that they really need. His Saudi counterpart said that the alignment could be seen with Saudi Arabia's Vision 2030. The broader Great Futures campaign, launched in Riyadh in May last year, has already brought $3.7 billion worth of deals and created more than 4,000 UK jobs. This latest round signals momentum, particularly in clean energy, finance, and technology. Looking further ahead, a full trade deal with the GCC would boost bilateral trade by 16% and add 1.6 billion to UK GDP. As Reynolds put it, our modern industrial strategy is giving investors the confidence they need to plan not just to next year, but for the next 10 years and beyond, helping to create economic change as part of our plan for change. So, to our last story, global bond markets rallied this week after weak US jobs data has raised expectations of a faster rate cut by the Federal Reserve. The JOLTS report showed job openings falling by 7.18 million in July, down from 7.44 million in June and below forecasts. Markets have reacted quickly. Yields on 30-year US Treasuries fell to 4.9%, while UK gilts eased back from 5.75% to 5.6%. Investors may have took the figures as a sign that the US labour market is softening, and we now expect up to a 5-point rate cut by September 2026. Elsewhere, Japan's 30-year yield hit a record before easing, and equities ticked up, with the Nasdaq rising nearly 1% and Google shares jumping by 9% after avoiding major antitrust penalties. But the bigger picture is still front of mind for bond traders: how the Fed will balance rate cuts against Trump's tariff policies and slowing global growth. Supply also plays a role. The UK have issued a record 14 billion in 10-year gilts this week, and governments in both Europe and the US have ramped up debt sales. This extra supply has helped push yields higher, even as central banks pull back from buying long-term bonds. Bank of England Governor Andrew Bailey summed it up when he told MPs, "You have been seeing a steepening of yield curves across the entire developed world. Really, the underlying driver of this is global." His point was clear. This is part of a much wider trend. This week's briefing once again highlights the strain economies are under, not just in the UK, but globally, with weakening job markets and rising debt levels. The fact that both borrowing costs and bond yields are climbing at the same time only adds further to pressure on government budgets. In moments like these, decisive government action is crucial. Yet, with Labour's budget delayed until late November, confidence is unlikely to receive that boost it really needs. On a brighter note, cross-border investment continues to move forward, with fresh commitments this week involving Saudi Arabia. However large or small, these kind of deals often create indirect benefits too, sparking future partnerships and encouraging more capital flow in the years ahead. With speculation mounting in the run-up to the budget, we're pulling together a more focused piece that brings all the moving parts into one place. The aim is simple: to prepare you as investors, whether that means highlighting new opportunities or raising awareness of areas where taxation could rise. Keep an eye out for this analysis ahead of next week's briefing. Thank you very much for listening. I'll catch you next week.